What's up, traders? Welcome back to the channel. Welcome to another Liquid FX YouTube video. Here we're going to be going over my outlooks for S&P 500 and the Nasdaq, so SPY and Nasdaq, and we're going to be going over what I think is going to happen in this sort of a midterm correction we're getting right after a bullish day here post FOMC. So this is S&P 500 or SPX 500, and here we're looking at the daily time frame. As you can see, how we trade here, we're an ICT-based community, and what we are looking for is fair value gaps for the algorithm or IPTA to rebalance in the future, right? So now over here, we understand that we're longer term bullish because we've had a huge bullish push, right? We've been bullish since October of 2022, and we've had a bearish break of structure, and we've seen an all-time high at the end of last year going on to 2024. So now we're in a region where if we are to see somewhat of a correction, we don't know how deep the correction is going to be, but we understand that where is price likely to target. Now from an ICT concept, we have obviously our fair value gaps and we have liquidity to target, right? So our liquidity is less prominent here in the daily time frame, but we are going to be looking at more so the inefficiencies in price because this is easier to gauge. So we have two inefficiencies marked out here in price. So first we have the daily inefficiency over here. So this is a fair value gap over here. So this is an inefficiency in price, a fair value gap. And over here we have the same thing. We have a fair value gap in price just over here. We have a few fair value gap candles here. So the way that our POI selection works is that we look for the last candle before the inefficiency, right? So we see an inefficiency over here. So our POI will be here to begin with, right? Now this here represents our fair value gap or our order block. Now if we continue up, we see the same principle being applied over here, where our POI, our place to target in a correction, will be this zone over here, because this zone leads to an inefficiency in price. So from here, if we're looking at a midterm correction in price, we will be looking for price to target these particular POIs or these demand zones, or whatever you want to call them, POIs, order blocks, right? So this is an area of inefficiency to target, right? So from an ICT perspective, we want price to balance or rebalance itself, and this is what we're looking for over here. So we're looking for price to rebalance. So rebalance inefficiencies, okay? Rebalance inefficiencies. So if we go down now to the 4-hour time frame, we can begin to dissect the price action in a little bit more detail, looking at PD arrays as well. So if we look over here in our most recent dealing range, our most recent structural dealing range gives us our low over here. This is our swing low or just our structural low, and this is our most recent high over here, our swing high. Now from here, we use the fib tool in a very specific way to give us our premium and discount zones, our PD array areas, okay? So if we dissect this PD array over here, it's very simple how to use the fib. It's nothing crazy. We take it from the swing low and we project it all the way up to the swing high. Now from here we understand that just like the daily time frame, we're looking for inefficiencies in price. We're looking for areas where price has left an inefficiency. Okay, so because we're in a bullish market, we're going to see inefficiency in the form of big bullish candles over here. So we see a fair value gap over here or an inefficiency, and we see the same thing down here. If I just zoom in so we can have a quick look at that, we have fair value gaps in this region, and we have fair value gaps in this region over here. So as a trader, right, we need to first do our analysis before we go on to take any potential trades, right? So as you can see over here, we have two zones we're looking at with the fib, right? We have our premium zone, which is up here, right? And we have our discount zone, which is over here. Now, you have to understand that the way that the markets work, if you're talking algorithmically, so looking at IPTA, so IPDA, the interbank price delivery algorithm, it's essentially going to be indexing PD arrays, and we're going to be looking from trading from premium to discount, discount back to premium. So what we're looking for is we're looking from premium to discount, yep, and we're looking from discount back up to premium areas, okay? That's essentially where we're headed with the idea of premium and discount. So we've dissected two of the most important concepts in ICT. We looked at PD arrays and we looked at inefficiencies in price, right? Inefficiencies in price. And this is represented by these POIs over here, these H4 POIs over here, these gray boxes, right? These represent inefficiencies in price action. So now that we can see that, we need to understand that we're seeing somewhat of a short-term correction as it stands. This is being recorded just after FOMC, so FOMC was bearish, and that's given rise to somewhat of a correction. So the question is, where will this correction go down to? How deep will the S&P correct? Now the truth is nobody knows. I don't know anyone really knows at this point. But we need to use our concepts of ICT, basic concepts of inefficiencies and liquidity, to get a rough idea of where we could go. Another thing I should point out is the idea of we have a trend line phantom over here. This is a very clean trend line phantom just over here. On the M15 or the lower time frames, it will be much easier to dissect and it'll be very clear. But it's essentially the same thing on all time frames, right? This is an area of liquidity over here. It's very clean upward sloping trend line, which also gives rise to the market heading lower, eating some of this liquidity, heading to these fair value gaps over here. So my overall narrative with the S&P 500 is for price to get down to this level over here as a minimum. Now the reason why this is a minimum level is because this hovers on the 0.5 level just over here. So this hovers at what you can call the equilibrium, or the 50% level, or the 0.5 level, whatever you want to call it. It is essentially the midpoint of this dealing range between the structural low and the structural high. It is the dealing range, and we essentially don't want to be trading at the dealing range. We want to be buying below in the discount and selling in the premium. So now that we have a premium over here, right, the way that the algorithms run, the way that the algorithms book IPTA, is it's looking for PD arrays from premium to discount, discount back up to premium. And that's exactly how our higher time frame narratives are made. It's made using liquidity, fair value gaps, and premium and discount arrays. So this is your bread and butter in any market, whether it's crypto, forex, the stock market, anything. Everything relies on the concepts of premium and discount, equilibrium pricing, structure, liquidity, and fair value gaps. Okay, so my overall narrative for SPY or the S&P 500, or if you're trading E-mini S&P 500's futures, it's for price to reach a minimum of this level over here. So this price here on the S&P 500 is 48.09, roughly 48.09. But really, we would more likely expect price to come down into a discount over here, and this discount H4PY, H4 refined in the daily, is 47.64. So these are sort of the levels I'm looking at on the S&P 500 post FOMC. Okay, so if we go down to the 50-minute, we're just going to dissect price action for today, and we're going to see how price behaves really, regardless of if a trade was taken or not. We're just going to understand how price actually worked today and how these algorithms actually work just on the M15. So we're just going to dissect price here on the M15. We're not going to go down to any lower time frame, but we're going to just understand how price books, right? Starting from what we call the consolidation range or the Asian range. So we have a larger consolidation in this range over here. So when it comes to the algorithm, something I've referenced earlier on in this video, when it comes to the algorithm itself is pretty basic. It can only do four things. It can either consolidate, expand, retrace, or reverse. That's all it can do. But it starts with what we call a consolidation. Now, the consolidation is essentially price accumulating liquidity, and with this market, it very often coincides with the Asian range, or that's one way I trade as well, looking at the Asian range as a form of the consolidation. So everyone by now has seen my videos, or if you haven't seen my videos, we've come across the concept of an AMD. Now, the AMD is the accumulation, manipulation, and distribution, and the accumulation phase is essentially the consolidation, right? Those two can be used hand in hand. The accumulation is very typically, for me, the way I trade the Asian range from 8 o'clock to New York midnight opening price. Okay, so this is the New York price over here. So what we see is we see London rally up, giving us the high of the day, or the manipulation, or the Judas swing, or the turtle soup, or simply just a manipulation. Okay, so this is how the markets book, right? So we want to trade in line with distribution. We want to trade away from manipulations in line with the distribution. So FOMC gave a bearish price action delivery today. So what we're doing is we're just looking and we're understanding the AMD, or the power of three. So what we see is we see a consolidation, a manipulation, and a distribution. An accumulation, a manipulation, and a distribution, right? So when it comes to entering trades, I didn't enter any trades here today, but if you're somebody who did want to, your job is to essentially enter off fair value gaps, okay? Because an order block over here is essentially an area where you can look to enter, right? If it's in line with your plan, if it's in line with your rules. So the S&P 500 today offered a nice trade over here in the London session. So you would want to have your stop just above the manipulation, and you can target a 1 to 2 or a 1 to 3 or 1 to 4, whatever your risk and your plan suggests. But in terms of price action delivery, this is how the markets would run. This is how IPTA operates on a daily basis from using the idea of power of three: consolidation, manipulation, and distribution, right? Or accumulation, manipulation, and distribution. So this is the bread and butter of how the markets book, how the algorithm actually books, right? So you don't need to know every single intricate piece of detail, but what you need to understand is the very basics of a bearish candle, right? A bearish candle will start off with an Asian range or an accumulation. We will see somewhat of a manipulation giving us our Judah swing, and then we're going to see a break of structure. And our job as traders is to catch the distribution down, right? Our job is to catch the distribution downward. So what we're looking for is a clean order block entry or a breaker entry, an OTE. Different traders within ICT quantums have different applications of entry models. I myself stick to a simple fair value gap entry, right? Nothing too crazy, nothing too fancy. I don't use breakers. I use more an OTE or just a fair value gap order block entry, really. Understanding the AMD and the power of three, getting your head around that is essentially one of the core concepts to ICT. So we have an accumulation, a manipulation, and our job is to sell during the manipulation phase. And this is exactly how the day presented today. This is how FOMC presented itself. Now, my only advice would be do not trade the news, trade after the news, as trading the news can be classed as gambling. You want to trade off the news to keep your account safe and to overall keep your mind safe as well, because you don't want to be trading in extremely volatile conditions, because FOMC is typically very violent. We see a violent up move and a violent down move, okay? So to sum this video up, the S&P 500 seems to be in a correction right now, and if we just go and look at price action again, if I get rid of that, make the charts a bit clearer, the S&P 500 has now potential to see a deeper correction down to these fair value gaps over here. So the minimum target would be here. Now, the reason why this is a minimum target is because this POI hovers at the equilibrium. This is at the equilibrium, right? The 0.5 level, or simply the equilibrium. Now, the equilibrium, if I can spell, the equilibrium is very simply the midpoint of the dealing range. So our job now is to trade from premium. So this is from premium down to discount, and our discount is going to be over here. Our discount is here, so we have a fair value gap to target here in the future. It may not get there this week, we may have to wait a week, we may have to wait 2 weeks, but this is how I'm seeing the S&P 500, and this very much stacks up with the NASDAQ as well, which we're not going to go through in this video. That's more for the private members, but for those who are interested, the link will be in the description for that. So if you like this video, give it a like, give it a thumbs up. Put your suggestions down in the comments. What else you want to see? What other markets do you want me to go through? I'm primarily into Forex and the US stock market, but if there's any other topics or anything people want to see, I'm more than happy to discuss that in future videos. So look forward to seeing you all in the next one.